Hi friends, if you have 25 lakh rupees of mutual fund portfolio and all of a sudden let's say you need 10 lakh rupees for a short duration, let's say 2 years of time, what are you going to do? Here are 4 options for you. Option number 1 is break this 25 lakh rupees of mutual fund portfolio and redeem 10 lakh rupees out of it. Option number 2 is take a loan of 10 lakh rupees against your mutual funds. That is second option. Third option is ask your father-in-law to give you some personal loan. And number 4 is asking your wife to maybe sell part of the jewelry or the gold that she has been hoarding for God knows how many number of years. Out of these 4 options, which are you going to go for? Pause this video and let me know in the comments. I'm very curious to know what your instant response is likely to be. One thing I know is that I am not definitely going to select option 3 or option 4. Why? The reason is very simple. A married man will understand the implications of going down option 3 and option 4. But on a serious note, if you make a bad decision here, you might lose lakhs of rupees. But at the same time, if you make the right decision, you might be able to save lakhs of rupees. Therefore, in this video, I'm going to run you through both these options, option number 1 and option number 2, and will tell you exactly how to think about these situations that happens in our lives. Sometimes all of a sudden we might need money. How to deal with such situations is what I'm going to present you now. So the first option is breaking your mutual fund portfolio of 20 lakh rupees and redeeming 10 lakh rupees. So let's say you have a mutual fund portfolio of 25 lakh rupees. You withdraw 10 lakh rupees out of 25 lakh rupees for 2 years of time period. Now the first thing that need to happen here is that there is going to be a capital gain tax that you are likely to pay. Let me now quickly show you calculations. So you've withdrawn 10 lakh rupees out of your mutual fund portfolio. Your capital gain tax will depend on 2 things. Point number 1 is your profit. How much out of this 10 lakh rupees was the profit that you gained? Let us say scenario number 1 is 20%, right? So out of this 10 lakh rupees, 2 lakh rupees is your profits. On this 2 lakh rupees, you will have to pay capital gain tax. Now, how much capital gain tax you will need to pay on this 2 lakh rupees will depend on how long it took for you to build this 2 lakh rupees of profit. If you took less than 1 year to earn this profit, then short-term capital gain will be applied on this 2 lakh rupees, which is right now at 20%. So 20% of 2 lakh rupees is 40,000 rupees. That will be your short-term capital gain. But if you gain this profit for a longer than 1 year time duration, then you will have long-term capital gain tax, which is right now taxed at 12.5%. Therefore, this amount comes out to be 25,000 rupees, which is 12.5% of this 2 lakh rupees. Now, depending on how much your profit was, your capital gain tax will be calculated. So if it was 30%, your capital gain tax calculation will be 60,000 for short term, 37,500 rupees for the long-term capital gain. If it was 40%, then 80,000 rupees for the short-term capital gain and 50,000 rupees for the long-term capital gain. So all in all, depending on your profit and depending on the duration of this profit, your capital gain tax might be somewhere around 25,000 rupees to almost 80,000 rupees. That is the tax liability that you will have to take care if you withdraw this 10 lakh rupees. So please make sure you are fully aware of this. But more importantly comes very big problem for you. What is the problem? Now let us assume that this remaining 15 lakh rupees of mutual fund portfolio continues to grow at 12%, right? And after 20 years, this will give you almost 1 crore 44 lakh 69,000 rupees of corpus is what you will build, right? Now, let us say this 10 lakh that you withdrew from your mutual fund kitty, you put this back after 2 years because your money need is done. You invest back this money into your mutual fund portfolio. So this 10 lakh rupees will grow for 18 years. If I look at the overall 20 years of your time horizon. So this 10 lakh rupees growing at 12% every year for 18 years is going to be around 76 lakh 89,000 rupees. Now, if we total this amount, it comes out to be 2 crore 21 lakh 59,000 rupees of the corpus you will build 20 years down the line if you go down this route of breaking your mutual fund portfolio. So the summary of option 1 here will be that you will have to pay capital gain tax. It might be any amount. In the examples we have taken, it comes out to be anywhere between 25,000 rupees to 80,000 rupees. And in our example, the corpus you will build is 2 crore 21 lakh 59,000 rupees. Now let us compare this option with option number 2, which is do not break your mutual fund. Do not interrupt the compounding. Let this 25 lakh rupees remain invested in your mutual funds. Rather, take a loan of 10 lakh rupees against this mutual fund portfolio. How will that work out? Let me now show you that this 25 lakh rupees will remain invested, and assuming the similar returns that we talked about in option 1, 12% returns I have assumed here in both cases, so that we can make the like for like comparison. And also if you look at the past historical data, Nifty 50 itself has managed to give around 11 to 12% of returns. So therefore I have assumed here 12% returns. Now for 20 years, these 25 lakh rupees will become almost 2 crore 41 lakh 15,000 rupees. Now compare this money with option number 1, which was 2 crore 21 lakh 59,000 rupees. So it's almost give and take 19 to 20 lakh rupees more that you are building in option number 2, where you are not breaking the compounding. This is mainly happening here because the 10 lakh rupees that you are withdrawing out of your mutual fund portfolio, you are only withdrawing it for 2 years. But guess what? Compounding works not only for 2 years, the returns that you would have earned in those 2 years also get compounded over a longer period of time. Therefore, over a 20 years of period of time, you are likely to make better wealth for yourself if you take a loan against mutual funds. But then you may say that, Rahul, if I am taking a loan against mutual fund, I will have to pay the interest on the loan. Of course. So let's also work out how much of interest you are likely to pay. So on a 10 lakh rupees loan for 2 years of duration, if I look at the loan rate to be 10.50%, you are likely to pay around monthly interest of 8,750 rupees, which comes out to be over 2 years period is around 2,10,000 rupees. So this 2,10,000 rupees is a negative impact that you are likely to see because you are going to pay this monthly interest at 10.50% interest rate. So if I were to summarize option 1 and option 2, we can clearly see that in option 2, we were better off in terms of the long-term wealth, around 20 lakh rupees in the examples we took. In option 1, we had a negative impact on capital gain tax, and it was somewhere between 25,000 rupees to 80,000 rupees in our examples. It could be very different for your case. The negative impact we saw in option 2 was the interest payment, which came out to be 2,10,000 rupees in the calculations that we did. But one could argue here that the savings in capital gain tax can cover for a lot of this interest payment that we have seen in our calculation. So clearly option 2 is much better option in my view. But one thing you might still be thinking is that, Rahul, you've talked about a loan rate of 10.50%, but if you go in the market, you might not be able to get a loan at 10.50% rate. Absolutely agree with that. If you go for personal loans may cost you somewhere between 15 to 20% of interest rate. But if you go for loan against mutual funds provided by Yenmo, their interest rate is 10.50%. And more than that, there are no hidden charges. There is a one-time processing fee of 1,179 rupees. And on that processing fee, you can get a discount of 200 rupees if you use my link that I've given in the description or in the pinned comments. Other than this processing fee, there are no hidden charges at all. Having said that, please do not take any loans if it is a bad loan. What is a bad loan? What is a good loan? Bad loan is a loan when you're taking a loan for depreciating assets. Like for example, if you're taking a loan for iPhone or for a fancy car, these are extremely bad loans. Please do not take loan against mutual funds if you're going for depreciating assets like iPhone or a fancy car or whatnot. But good loans are those loans where you are investing in yourself or in your business. For example, if you're taking an education loan, makes sense. Another example could be you're taking a business loan where your business is growing at a 20% rate and you're taking a loan, let's say at 10%. Yes, of course, that's a very, very good deal. So please make sure you're not taking a loan against mutual fund, which is a bad loan. You are taking a loan that is needed for your business, for your personal growth, and you know that you can afford to make monthly interest payments on time. Otherwise, please do not take a loan that you cannot afford. Now, assuming you want to take a loan for the right cause, loan against mutual fund is a very, very flexible value proposition. Let me explain to you some finer details about it. First point is that there are no foreclosure charges, meaning let's say you take a loan of 10 lakh rupees against mutual funds and you take this loan for 2 years. But after 1 year, your money need is fulfilled and you want to repay back this money, 10 lakh rupees in full. You can absolutely pay this 10 lakh rupees anytime during the 2 years of loan period, and there will not be any early closure charges or foreclosure charges for you to finish your loan. So that's a very, very good flexibility that all of a sudden you need a money for whatever reason. You take the loan for 2 years, and as soon as your money need is fulfilled and you are ready to pay back your 10 lakh rupees, there will not be any penalties, there will not be any foreclosure charges, which makes loan against mutual fund by Yenmo a very, very good feature in my view. Second feature that you need to know is that what happens if you want to make a part payment. So you, let's say, take a loan of 10 lakh rupees. After 3 months, you have 2 lakh rupees that you want to pay back. Are there any penalties? Absolutely not. You can pay back this 2 lakh rupees. Out of the 10 lakh rupees, now you have paid 2 lakh rupees. So going forward, interest amount will be calculated on the remaining 8 lakh rupees. There are absolutely no penalties. There are absolutely no hidden charges here. So good thing about loan against mutual fund that is provided by Yenmo is that you can do part payments without having to worry about any penalties or charges. Third feature of loan against mutual funds provided by Yenmo is that you pay monthly interest here. And this is very different from many other types of loan. For example, in home loan, what you do? You pay your EMI and part of the EMI goes to principal amount and part of the EMI goes to the interest payment. Here in the loan against mutual funds provided by Yenmo, you are not paying your principal amount in the monthly payments. What you're paying is your interest amount. Your principal amount you can pay any time during the 2 years duration. You can pay it at the end of the 2 years. You can pay it during the 2 years. That's the flexibility loan against mutual funds by Yenmo is providing you. Moving on to next feature, which is how much maximum loan amount can you avail. So you can take a loan of up to 50% of your equity based mutual fund portfolio, and you can take up to 80% of your debt mutual fund portfolio. So for example, let's say you have an equity based mutual fund portfolio of 25 lakh rupees. You can go for maximum 12.5 lakh rupees of loan against this 25 lakh rupees of mutual fund portfolio. But if you have a debt mutual fund portfolio of 25 lakh rupees, then you can go even higher, which is 80% of this 25 lakh rupees, which comes out to be 20 lakh rupees. You can take a maximum loan of 20 lakh rupees against this debt mutual fund portfolio. Also, when you apply for loan against mutual fund, the first thing you get is a credit line. So let's say 50% of this 25 lakh rupees, which is 12 lakh 50,000 rupees, is your approved amount. This approved amount is called credit line. You will not be charged interest on this. You will be charged interest on whenever you withdraw any money out of this 12.5 lakh rupees. So that way it is very, very flexible in terms of first getting the credit line approved. And as and when the money need comes, you can withdraw amount from this 12.5 lakh rupees. And depending on how much you withdraw, your interest will be calculated on the withdrawal amount, not on the credit line. So there is a flexibility of having this credit line, and depending on your need, you can just withdraw the amount that you want. Next point is how to apply for this loan. And this is such a simple process that you can avail this loan within 10 minutes of your time. There are no need for income verifications here because simply you are pledging your mutual fund unit against the loan that you are taking. Therefore, there is no need for income verification here. Next point about these loans is that these loans are regulated by RBI. And therefore, when you take a loan against mutual funds, your mutual fund units are held with the RTA, as is the normal case. You remain the owner of these mutual funds, but there is a lien that gets created against your mutual funds, but you continue to own your mutual funds. Yenmo has partnered with some of the largest NBFCs, for example, Bajaj and Tata. These NBFCs have strict protocol and they follow the rules and regulations. Therefore, this process is entirely secure and safe. But comes $1 million question that, Rahul, if I take a loan against mutual funds, during this loan period, can I sell my mutual funds or not? The answer is yes and no both. Let me explain using an example. Let's say you have a 25 lakh rupees of mutual fund portfolio and you take a loan against mutual fund which is 5 lakh rupees. Now, if this 25 lakh rupees mutual fund portfolio that you have is an equity based mutual fund portfolio, then what happens is that twice the amount of your loan. So you have taken a loan amount of 5 lakh rupees. 2 times of 5 lakh rupees is the 10 lakh rupees. You cannot sell 10 lakh rupees worth mutual fund from your portfolio, but remaining 15 lakh rupees, yes, you can go ahead and redeem them if you need to. For this, you will have to go to Yenmo platform and simply remove the lien for 15 lakh rupees. You can self-manage it, very, very easy to manage it, and go ahead and sell your mutual funds if you need to. Next point is what happens if you are not able to make your monthly interest payment. So please understand that you have pledged your mutual funds against this loan. Therefore, part of your mutual funds will be sold to recover this monthly interest payment amount. It is extremely important you only take this loan if you can afford the monthly interest payment. Otherwise, please do not take this loan if you cannot really afford the monthly interest payments. Also, if you miss to pay your monthly interest payment, there is going to be bounce charges, which right now is at around 1200 rupees. So please make sure that you're only taking these loans if you know that you can afford to pay the interest payments, which is the case with all types of loans, that if you cannot really afford to take any loans, then never go for a loan. Only take loans if you can afford your loans. So in this video, I've covered a lot of features of loan against mutual funds. Let me know in the comments if you still have any questions. I would love to go and read your comments, answer as many as possible. If you decide to take loan against mutual funds, you will find the link of Yenmo in the description or in the pinned comments. With that, I hope to see you in my next video. Until then, keep rocking.